to start off before I introduce the panelists, sort of to set the scene for those of you who are not steeped in what's been going on in Africa. Certainly in the last decade and a half, and with increasing interest in the last several years. When you look at sub-Saharan Africa, which is of course a continent comprised of 48, 49 countries, depending on which nomenclature you use to define a country, it's really a heterogeneous group of countries. It's not a monolith. But when you look at the continent, the subcontinent as a whole, over the last decade and a half, average gross domestic product, or GDP, in real terms, has been above 5%. We in the US and the EU and Europe would die to have that kind of growth record. And I point out that it's a long growth record precisely because it is a structural shift that has been taking place in much of Africa. And it's that backdrop, with the rise of the middle class, with increases in flows of foreign direct investment, whether in the corporate sector, whether in the international multilateral sector, or in the private equity sector, which is our topic tonight. It's very clear, I think, when you look at this long view, that Africa as a continent in general, and some countries more than others, which we'll talk about this evening, have reached significant inflection points. And as someone who cut his teeth on China in the early 90s and then Russia during the 2000s, which is where I got my gray hair, I recognize these inflection points. And it's very clear to me that there is an inherent resilience now in many, though not all, of the sub-Saharan African countries. And so one might wonder, well, this is a nice long track record, but how did these countries in Africa fare during the economic crisis over the last several years? Well, if you look at the numbers, which I have, and maybe some of you have as well, what you find is from initial conditions across all the regions of the world, the average African economy actually proved to be more resilient over that business cycle than any other region, which is not intuitive to many people. And when I was at the World Bank, a couple of jobs before joining PwC, as this crisis was hitting, our task by the president of the bank at that time, Paul Wolfowitz, was, we want an analysis about how the continent is going to fare during this economic crisis, and what do we have to do in terms of pumping aid in. And lo and behold, and this is why we're now seeing private equity take root in the continent, is because the policymakers were smart. Where there were price controls put on to try to alleviate the pain from the crisis was not in Africa. It was in places like Russia or China or other countries. Where there was protectionism, it rose in the US and the European Union, not in Africa. And, the story usually is, well, most of African countries are in the commodity business, and they're not climbing the value chain and producing value-added products and services. Well, that's also begun to change. I don't want to overstate it, but this is not your grandfather's Africa. It's not even your father's Africa. And I think one of the themes that will come out of this discussion tonight is the time compression of changes taking place in the continent of Africa. And it's moving very swiftly. And what used to take 5 years to bring in a change in taste, market changes, now occurs in 2 to 3 years' time. And the last thing I'll say, which I think bodes very well for thinking from both the private equity perspective and general as an investor in Africa, is inventions are now originating on the subcontinent of Africa, which really is turning on its head Ray Vernon from Harvard Business School, late professor who invented the product life cycle, the notion that inventions would originate in the advanced countries. They would then become more diffused and be sold in Europe and middle income countries. And then finally, they become commoditized and be sold in the developing countries or the emerging markets. Well, today, mobile money being a great example is something that was invented, to be sure, out of necessity, but nonetheless invented in sub-Saharan Africa and is only now beginning to come to the US. And it's very difficult to take a taxi in certain cities in Africa and pay for it in cash, right? You use your mobile phone. So it's these kinds of issues, I think, that brings the interest on the part of private equity investors and corporate investors in general to the subcontinent. So with that context, let me just introduce the panelists, and we are really delighted to have such a great mixture with us tonight. To my immediate left, Sean Klemenczak is Senior Managing Director at Blackstone, a company that maybe some of them have heard of. To his left is Dave Marchek from the Carlyle Group. He's the Managing Director based out of Washington, where the company is headquartered. To his left is Kola Olafimbawa, who is from the Fairview Group, based in West Hartford, Connecticut, Nigerian by birth, and leads the Africa investment practice for Fairview Capital. And then, last but not least, Hurley Dottie, who is, like me, is also based, and like David, is also based in Washington and is one of the co-leaders of Emerging Capital Partners, has been a very long standing firm or fund investing in Africa. So I thought maybe we can, I think the first thing I'd like to be able to do is sort of level set for the audience how your various funds differ from each other, because you're not all the same, different histories of investing in Africa, different goals and objectives. And so maybe if I can just start with you, Sean, and just sequentially, take 2 minutes each, and then I want to really stir up a conversation.
Sure. Again, my name is Sean Klemenczak. I oversee power and natural resources for Blackstone around the globe. I invest out of our global private equity fund, which combined with our energy funds is about $19 billion of capital. That capital is invested all around the world, so there's no specific geography in mind. And by and large, in Africa, what we invest behind is growth equity. And just about everything that we've been doing in energy over the last handful of years has been greenfield development projects. So anything from developing the Bujagali hydroelectric dam, which is about a $900 million project in Uganda, to investing in Cosmos Energy in Ghana. So we're, by and large, going to continue to invest behind good management teams in Africa going forward.
David?
Dave Marchek with the Carlyle Group. Thanks for having me here. We have a slightly different strategy than Blackstone. We tend to have regional funds or sector-specific funds that are dedicated to a particular region or sector. And so we've set up a business in Africa based in Johannesburg and Lagos, and we are investing mostly in corporate-type assets, small to medium, well, I guess medium to large-sized businesses in Africa, but what would be considered small to medium-sized businesses in the United States, and focused heavily on consumer-driven, middle-class-driven sectors of the economy.
My name is Kola Olafimbawa from Fairview Capital, and thank you very much for having me on this panel. We're a US-based investment manager. We manage several funds of funds and single-client funds for institutions in the US, really primarily focused on venture capital, growth equity, and then emerging managers in the US. Recently, we've decided to go to Africa, and for this effort, we've partnered with FMO, the Dutch Development Finance Institution. They've been investing in Africa since 1970 and in African private equity since the mid-1990s. So they've been foundation investors in many of the leading firms on the continent. As was mentioned, I lead the African practice at Fairview. Have been at Fairview for 7 years.
Hurley.
My name is Hurley Dada. I'm with Emerging Capital Partners, and we are a Africa-focused private equity fund. That's all we do is invest in Africa. We've been investing since 2000. Over that period, we've made over 50 investments into companies in Africa. Invested about $1.3 billion in that. We invest quite widely across the continent. We've invested in over 40 countries in Africa. We are very much growth investors. We're in a pretty wide variety of sectors. We're in diapers, bottled water, rubber, power and water, airlines, cable television, tuna fish processing, and a number of other sectors like that. So we see a lot of opportunity in a lot of sectors and in a lot of countries, and it's been a good growth economy for us, and quite an interesting place to invest.
So, clearly, as I was alluding to in the beginning, these entities are different. ECP has been in the Africa game for 13 years. Blackstone and Carlyle, and I guess even Fairview, are relatively newcomers, so to speak, if that's fair.
9 years, yeah.
9 years, okay. Well, that's older than I thought. Okay.
Well, our partner has been there for 40 years.
Okay, well, yeah, so what I'm trying to understand is what are you guys seeing in Africa now? Maybe start with you, David. Carlyle made a big announcement about the fact that you were going into Africa several years ago, versus, whether it's Fairview or a 9-year Blackstone or ECP, which has been there for 13, if not more years. What is it that propelled, Carlyle to make this decision now?
Well, I think you hit on some of the macro topics, which is that the region is growing very fast, 5.5% growth. It's the fastest region growing outside of China or India. You have more stability. You have a growing middle class. You have improved governance and stronger institutions, which create the resilience in these societies that you talk about. We tend to try to be an early mover in emerging markets. We're one of the larger investors in emerging markets around the world. And for example, we went into China 1998 and have become one of the biggest investors there. Same thing in India, same thing in Brazil. And so we wanted to be one of the early movers there and build a business, hopefully before others that of the larger firms can catch up. Our investors, I would say, are increasingly interested in allocating capital to frontier markets and emerging markets. We see China as really a country that has emerged, and Africa, sub-Saharan Africa, is a region that's emerging. And I would say also that there's kind of an intangible test that we have, which is when you talk to Chinese 15 years ago, they wanted to come to the United States, go to the best business schools or undergrad, and then stay here and work here. And the last 8 to 10 years, those same high achieving Chinese have wanted to go back to China. And the past, I'd say 4 or 5 years, we've seen the same thing from countries in sub-Saharan Africa, where you get the best and the brightest coming here for school, but they want to go back. And to us, that's a signal of confidence and a signal of opportunity that the most talented people, frankly, want to go back to the countries where they grew up because they see greater opportunity there. And that's a very important intangible signal for us that it's probably a good place to invest.
So Hurley, what did you guys see, or maybe driven by your investment philosophy, that others didn't see, since you were really in the vanguard of investing in Africa and in some really creative sectors?
Well, certainly it was not as obvious a play in 2000, I would say. But on the other hand, a lot of the foundation had really been set in the 1990s in terms of really the structural adjustment, getting a handle on the debt issues there, and importantly, just a beginning of a reduction in the role of the government in the economy there. And that's something that really happened in the 90s. And the effect on the economy was similar to the effect in Eastern Europe, similar to the effect in China. It started a growth boom, and we were lucky enough to be there at the beginning of that, but that is something that has, if anything, only strengthened. It's combined with, I think, favorable demographics. You know, we got 1 billion Africans. It's a young continent. It's a growing workforce, unlike much of the world, which is a shrinking workforce and a shrinking a population. So, you know, Africa is eventually will have a bigger workforce than China will, and you know, that's gives us good confidence for 10, 20 years of continued growth there.
And Sean, if I understood correctly, your entree, maybe just at least yours, to Africa has been in the energy and the power sector. Is that correct?
That's right.
And so maybe you just might explain. You know, we obviously do see a lot of growth in the retail sector now, in other parts of the services sector, the infrastructure sector. What's behind the Blackstone philosophy, if you will, in terms of the energy plays in Africa as opposed to other sectors, for instance?
Sure. I think there are two stats that really crystallize our thinking. The first of which is that if you take a look at Africa as a continent, it has the installed power base of Spain, but yet has 20 times as many people. It's a pretty shocking stat when you think about it, and so it does just highlight the electrification issue that Africa faces. And the other one that you alluded to before is that the continent in general has its economic house in order. And you take a look at debt to GDP in countries like the US, where we're at 100%, and you take a look at the average sub-Saharan African country with mid-20s debt to GDP. We look at this and we say, there is not only the desire for power, but there's also the ability to pay for power. And so for us, what we've been really focused on is not buying existing assets, but backing good developers of people who have good ideas and trying to find ways to bring lower cost power to Africa. And so in Uganda, where we doubled the amount of power in the country, cut the cost of power by 2/3, and expect to double GDP growth, you can identify a good project when you see it. And so for us, what we're trying to focus on is transformative projects with good project developers, and we think that by, very similar to Carlyle, by being there early in many of these countries with transformative projects, that will then position us well to try to understand the economies on a go-forward basis.
Kola, in the practice that you're now building for Fairview, where do you fall in terms of your investment thesis, in terms of supporting greenfield ventures, startups, if you will, versus, for the sake of argument, investing in going concerns that want to get sort of to the next inflection point? What undergirds Fairview's philosophy when you think about Africa, and what are you looking for?
Yeah. So in terms of how we have looked at Africa, historically what we've done in the U.S. is we've raised funds of funds. And at this point in time, there is now a very healthy stable of experienced private equity funds across the continent, where you now have institutions who want to access these funds, but who don't have the wherewithal to have the teams in place to appropriately diligence them, screen them, and invest. They can now utilize an intermediary who is willing to invest in the team, the infrastructure, the network building, and the work, that goes into investing in a broad, continent. So for us, that's probably the biggest thing we've seen that's made us say, this is the time to go into Africa. You then overlay that with the demographic virtuous cycle that's been talked about, the democracies that have come up across the continent, and just the sense that this time is different. There is something happening. There's a significant structural shift, and we think it's there to stay. Yet, when you look at the amount of private equity capital that has actually come into the continent over the last 10 years, you don't really see a spike. You know, it's grown a little bit, but it hasn't really spiked. So we think the opportunity is still very early. And for people who get in now, I like to say the windscreen is a lot brighter than what you see in the rear view mirror.
So for folks who may not appreciate the difference between fund-to-funds approach versus direct investment, maybe you just might explain why, I mean, you've explained a little bit why you're acting as, in essence as an arbitrager and bringing the expertise, but I wanted to sort of contrast, for the sake of argument, sort of what Hurley's firm is doing, and maybe just tell us why you believe the fund-to-funds approach is a profitable opportunity for you guys as opposed to another.
Yes. So a typical private equity fund will invest in entrepreneurs, they invest in companies, help build those companies, and then divest them, hopefully at a profit to return to their investors. When you have a lot of these funds, for an investor, it might be who doesn't have the networks or the team to pick the best of these to build a portfolio. There are firms like mine that invest in that infrastructure, invest in those teams. So we raise money. We have outward investors. So we have one hat where we are general partners, where we raise capital from investors, and then we turn around and become limited partners in funds, and we build a portfolio of funds and create diversification for our limited partners. If we do our jobs properly, we help to mitigate the risk that you might get, the idiosyncratic risk of investing in any single fund which might, blow up. Yet, if we are still picking the best of the best managers in that market, you don't sacrifice much in terms of performance. We do charge a fee for that, but if done properly, it's still worth it for the investor who, one, might pick wrong investment, so there's a cost to that, or two, if you had to build the team internally, there's a cost to that as well. That doesn't happen for free.
So Hurley, you're not a fund-to-fund entity, correct?
We are not. We are direct investors. We raise a pool of money and then look to invest that money in 8 or 10 companies, and then help develop those companies, sell them, and then start the cycle again and raise money again.
And how do you mitigate the risks that Kola mentioned without sacrificing the returns? What's the process by which you, in essence, select your investments?
The risk is even in a single fund is mitigated by diversification. So we typically be in maybe 10 different companies, different sectors, operating in different countries, and then we do a lot of due diligence in order to try to pick the best companies in the various sectors that we think are going to perform well. So that's part of our that's the main focus of our business, is to find good growth businesses to invest in.
David, you mentioned China, which is a country near and dear to my heart, and Carlyle's experience there, and obviously in other big emerging markets. What lessons, whether organizationally, whether in terms of investment thesis, whether in terms of risk mitigation measures, has Carlyle brought or is bringing as part of the new venture, if you will, in Africa?
It's a good question. We bring the same approach in each region. And so, for example, in China, where we're one of the larger investors, we've done, I think we've invested about 55 transactions and over $4.5 billion since we've been there. So it's a pretty active market for us. We tend to focus on sectors which we know the best. We tend to focus on transactions where we can actually add value, where there's some niche or some capability that gives us a differential capability to help that business grow faster, to expand internationally, to strengthen their governance, to improve their financial management. And I would say it's the same approach in Africa, which is we're focused on sectors which we know very well. We're focused on sectors where we can help them globally. It's one of the benefits of our platform, at least we believe. And we're focused on companies where we can really understand the business and assess it and strengthen it through its cycle. You know, in China, we have tended to invest in non-state-owned enterprises, and that'll be the same in Africa. We've done a lot, we've backed a lot of entrepreneurs, and that'll be the same in Africa. We've done mostly minority investments, growth investments. That'll be the same in sub-Saharan Africa. And we have focused on companies where they have a particular need where we can provide particular value. So family-owned businesses where they've grown to a particular size and they need the management capability, the financial management, the branding, all the things that one would think a larger firm like Carlyle or Blackstone can bring to the table to help that company get to the next level.
How decentralized, if you will, geographically are the Blackstone investors? Are they, do you have a full-fledged fleet throughout the continent?
We do.
Or you do?
We do.
And what, how many, roughly, I mean, what countries or people, just a sense?
Yeah, it's a good question. Our investors are very global. I would say we've got, you know, to give you exact percentages, I wouldn't have it off the top of my head, but I would guess something in the order of magnitude of 10% of our investors are from Africa, and I would guess if you include the Middle East, we're Africa, Middle East, we're probably a quarter of our investors from the region.
So I guess, sorry, maybe I should have been more careful. In terms of the Blackstone personnel
Sure.
who make the recommendations to what I gather is the investment committee,
Right.
Where are they stationed?
They're stationed either in the, I guess, U.S., Europe, India, or Asia. So it's actually, we're more industry focused versus geography focused, which is why people like me rack up 350,000 miles a year. So.
Hurley, you know, obviously I've known Hurley for a while. I know the firm, but you've really decentralized in a much bigger way over the decade or so that you guys have been in business. Can you just share sort of the lessons as to the benefits, obviously, since that's why you're there, of decentralizing and how your profile from a control perspective and investment decisions?
We have about 70% of our investment professionals stationed in Africa. We've got 7 offices across the continent, and you know, that allows us to have people on the ground to work, you know, hand in hand with the companies there and help develop them and to you know, understand what their needs are. So over time, we have migrated people. We did start out with a good percentage of our people in D.C., and it's certainly important to be able to act like a team and to have people know each other. But over time, you know, we found you know, getting more people on the ground closer to the investment destinations has been quite useful for you know, for the type of businesses that we're investing in.
So that helps you upstream, presumably in the due diligence, but also in the downstream portion of managing the investments. Is that
exactly? You know, it helps to be in the various regions of Africa as well. Partly too because many of the businesses that we're investing in, they are growth businesses. Many of them are looking to expand into other regions in Africa, and you know, having a presence there and contacts there is interesting to them because you know, it means that we can help them with their expansion plans.
So, Kola, as you're building this business, what I'm really interested in, and hopefully the audience is as well, is who are your competitors in light of the fund-to-fund approach that you're taking, and what strategies, if you will, are you undertaking in order to thwart your competitors? And hopefully there's nobody up on the table that's a competitor.
Well, actually, you started my answer from, because actually, in some ways, our competition is actually quite broad. Because if you look at it from the perspective of an institutional investor who has, you know, spent some time studying what's happening in Africa and says, I want to do this, there are probably 3 or 4 fundamental ways they could. In the first instance, they could go and start investing directly in companies. Probably won't do. Second, they could find one or maybe two funds that they like that are doing quite well or that have done well historically, and they could invest in those directly. Or they could build a team internally to build a diversified portfolio similar to what we would do. And then lastly, you could use a group, an organization like us and our partnership, with FMO. But more specific to your question, within that fund-of-fund space, there are probably about 2 or 3 other groups that are trying to do something similar. And I'm not very privy to, the different, strategies. And also, as I mentioned, we are fundraising. So there are only so much I can say, except for people who are interested, it's a different process in terms of talking to them. But suffice to say that, it's not just fund of funds, but we also are very expert at co-investing with the funds that we've invested in. And so that, again, that brings it, in some ways, adding to some similarities to what the direct, funds do. So that there are various ways that you enhance the value that you deliver to your investors, and which we think we can do in this instance.
The co-investing theme is a really important one. When I was in the private equity business for a couple of years, we did that as a matter of course. Does Carlyle or Blackstone, what's the philosophy about partnering, co-investing? How do you go about, if you do that, how do you go about, apart from the usual due diligence, what's the philosophy under which you select co-investors, if that's the route that you take, and if not, why?
Let me first describe the way we are structured there. So 100% of the people that are investing in the region are in the region, from the region, so really reflecting the region. So we have a South African based in South Africa. We have a fellow from Zimbabwe who was educated in the UK, lived all over Africa, now is based in the region. We have a Tanzanian who grew up in Liberia, who's based in Lagos, so all African team in Africa. Co-investment is becoming a much more important part of all of our business, Blackstone, Carlyle, every private equity firm. And I'd say there's 2 different types of co-investment. One is that our investors, our limited partners, pension funds, high net worth individuals, foundations, et cetera, they want to co-invest more and more with their general partners. And so that is part of a trend where the firms like Carlyle, Blackstone, we want our investors to be happy. They want co-investment, and so we try to give them co-investment opportunities. So in many transactions, if we're putting a particular amount of equity in a transaction, and we don't want to put more for a variety of reasons, for risk, for diversification within a fund, we will often then provide our investors in a particular fund with opportunity to co-invest alongside us. There are also times when we will partner with other firms. We've partnered with Blackstone on a number of transactions in the United States and around the world, and we've done that in the region as well, where we, for whatever reason, can't or don't want to take all the risk in a transaction, and will want to bring in a partner that has a particular comparative advantage that can help in ways that we may not. And so we're always looking for partners that have the same type of philosophy, which is long-term, patient capital, focused on growth, supporting the entrepreneur, and we find different co-investors for different projects.
Is it very similar?
Yeah, I'd say it's very similar in that respect, so I won't hit on the 2 types of co-investors that Dave hit on, but I would highlight 2 others. One, strategic partners. So take, just for example, if you're investing in a media company in the U.S., as we did with the Weather Channel, we partnered with NBC. It's a tangible one that we can all relate to. The same thing is true when you're investing in energy in places like Africa. Having a good strategic energy partner makes a ton of sense. And then maybe the 4th type of partner that you might seek in a place like Africa is a good local partner. As I said, for us, we're really focused on looking around the globe to try to find the best opportunities and not just always doing Africa throughout a cycle, because there will be times when it's interesting, when it's not. And so for us, the way that we try to get that local feel is partnering with local institutions and successful entrepreneurs in those countries. So take in Uganda, we partnered with the Aga Khan, who, as many of you from East Africa know, has an unblemished track record and reputation. So for us, a lot of it is about how do you make yourself more local, and how do you ensure that you truly understand what it is that you're doing, and we've done that through local partners.
Are the multilaterals, whether it's the African Development Bank or the World Bank, are they big players, or have they diminished in size? Hurley, I gather you guys must have or are partnering with them. But what I'm trying to get at is the sort of the shifting landscape, if you will, perhaps from public or multilateral to private. What does that look like over the 13 years?
They are big players, and you know, they remain big players. To some extent, the multilaterals' role in the rest of the world has decreased. So the need for them to finance things in Brazil or finance things in China has decreased, which means that more of their focus is on Africa. And they are big players both in terms of investing in funds and also lending in Africa. On the other hand, the economy and the needs are much bigger than they are. So you know, in the long run, it's the private capital that's going to be much bigger than them. But they've certainly played a very important role both in launching the industry really, and in supporting projects at an earlier stage in order to set that track record for the private sector.
Yeah, I would just add to that. I think the multilaterals play an integral role in Africa today, as you're thinking, especially on the infrastructure side, where the goal of all of these countries is to lower the cost of capital. The involvement of the IFC or the African Development Bank or KfW, or name the DFI, those folks participating in a deal, number one, have a perceived insurance value to Western investors, and number two, they also do actually explicitly provide political risk insurance, which does otherwise lower the cost of capital for those countries. So take the MEGA insurance policies, where there have been over 500 insurance policies issued. They've had less than a 1% default ratio. That type of partnership, where not only do you have the political alliance with those organizations, but also just the economic protection from them, I think is critical, especially when you're thinking about large-scale investments in Africa today.
So are you guys telling me I shouldn't have left the World Bank several years ago? Is that I made a mistake?
Well, I think I have a view on that as well. I think not on your departure from the World Bank.
I think you made a wise decision coming to PwC.
But more in many ways, the DFIs, I think, have de-risked the opportunity. You know, they were there early. They were there when, you know, commercial investors were wary of investing in that market. And in my mind, it's not too dissimilar to what we saw in the development of private equity in the US, where it was very, very, very ultra high net worth, you know, families who first started, you know, in private equity, and then in the 70s, 80s, you started to get institutional, you know, investors involved. You see an evolution similar to that, where the DFIs were early. They had additional motivations to invest, but they have now proven the case that you can invest successfully in private equity in Africa, and now you see commercial investors, you know, coming in more strength.
So to shift slightly from the traditional investors of the multilaterals or the bilaterals, we have some non-traditional investors and actors in Africa, certainly over the last decade and a half, in the guise of the Chinese, the Indians, the Brazilians, the Russians. How have they altered the terrain in the private equity business? We know how they've altered the terrain a little bit on the corporate side, but any issues there that merit discussing?
Well, I was going to say, first of all, it gives us a wider a group to possibly sell our companies to once we've built them. Certainly in 2000, when we started, very much European that's who the strategics were, who were looking, had long-standing presences. Now, you know, certainly the Indians are big players. I think they've got big companies They are comfortable at the income level that you have in many of these countries here. And they've been successful, and they're looking to expand in a number of industries. The Chinese to date have been more government-to-government players. They're not as likely to go and buy and try to take control of an African company, but I assume that's going to change. You see that as well in the Gulf. Gulf companies, they do well. They've got a lot of money. They need to expand to find some markets, and they're going to be comfortable expanding into North Africa in particular. So we've seen new players coming into the market. The other thing you've seen is as companies within Africa will get bigger, they also now look much more to expand into other regions. So that's both the South Africans looking to come north and buy something, but it's also the Moroccans looking to come down. If you build a very big Nigerian company, you start to say, well, let's expand. Let's go into Ghana. Let's go into Kenya and see what's there. So all those factors are going to make, I think, in the next 10 years. More sales to a variety of different countries, because really around the world people are looking and saying, Africa, that's a market where there's growth, where there's some new prospects. Let's go there. So we've seen it a lot.
Just to finish up on this, what has been roughly? I'm sure this is in your documents that you use for marketing, but what's been your average rate of return on your Africa funds?
It's not normally something you ask. Our average rate of return on our exits, we're about 2.4 times the money on our exits.
And how are you guys? Is that?
He has more permissive lawyers than we do.
Same here.
Okay. What are your aspirations? Okay.
My chief compliance officer does not allow me to.
That's good. I guess the last thing I want to ask before we open it up is, this is private equity, and obviously we're talking about an emerging developing country region where there are great public sector needs, right? When a Carlyle or Blackstone or Fairview or ECP make investments, how much does the public payoff, public benefit, the social benefit figure into the calculus? Do you want to?
Sure.
Does your lawyer allow you to talk about that?
Certainly. I think for us, it's I wouldn't say that there's any external input to the equation in terms of the social benefits. But the thing we do look at, I'd say particularly closely when we're investing in Africa, is this the lowest cost, best option for the country? Because we think one of the best protections in any situation is that you're the best project out there. So if you're a hydroelectric dam in Uganda, you sure as heck want that to be the lowest cost option for the country. And so we are focused on that. And obviously the additional benefits of a project like our one in Uganda is a positive thing. But I wouldn't say anyone simply says, well, we're going to effectively add an extra few hundred basis points to this return simply because we're doing good as well. You've got to do good for the local economies, and you've also got to do well for our investors.
Kola, did you?
Yes. Well, our partner is a DFI, and for anybody who's familiar with the leading DFIs, the environmental, social, and governance issues are huge, for them, and they have led the development of best practices in the companies that they have invested in on the continent, and this will be no different in terms of what we want to do. That said, we don't believe there is any compromise between doing that and also investing in the most commercially viable companies. In fact, we think that's the only way that what we're trying to do is sustainable, because this is not aid. You're going to invest, you want to make money, you want to generate returns for investors so they come back. But in doing that, we believe that you will also generate goods, for the environment that we're investing in.
I just want to add, too, in general, private equity has a pretty good reputation in Africa because we are fundamentally growth investors in Africa. And in a developed market, slower market, a lot of the business is really going to be restructuring struggling companies, borrowing money and firing people and closing plants and getting them back in shape. That's just not really the business in Africa. It's almost all growth companies. We're looking at a good company that wants to get bigger and better and provide its services somewhere, and and fill in some of the mini gaps in Africa. So I think fundamentally, that's something that gives it a kind of a better name than it has in some other places.
David, do you want to?
I would say our model in the United States and elsewhere is also growth-oriented, so we don't fit the caricature that some might think of. I would say in Africa, we have a very rigorous evaluation of the ESG factors as well. And I would also say that our investments so far have tended to be consistent with a lot of the development goals of both the leaders in the region and also of multilateral institutions. So, for example, our first investment was in the agribusiness sector in a distribution company that's very focused on regional integration in Eastern Africa, that's bringing products from small farmers to the market and creating efficiencies. And so our themes are going to be very heavily focused on strengthening the middle class, upward mobility, regional integration, and in the sectors where there's a very, very positive social benefit as well. And so, in my view, our investment goals and the general broader societal goals are inextricably intertwined.